what if I told you that you could own a tiny piece of some of the world's biggest companies? And get this, without needing millions of dollars to do it. Well, that is exactly what happens when you buy a stock. I know, it sounds almost like a magic trick of the financial world, doesn't it? But it's actually a very real, incredibly powerful concept that literally forms the backbone of the global economy. Today, we're going to completely demystify this. By the end of our time together, you're going to understand exactly what you own when you purchase a stock and how the whole shebang actually works. Welcome to The Explainer. Okay, let's dive into this. What exactly is a stock? We hear words like stock, share, and market thrown around constantly, but they're usually wrapped in all this confusing financial jargon. So let's strip all of that away and go right back to the absolute basics. A stock is simply ownership in a company. That's it. When you buy stock, you are buying a legal slice of that business. A share is just a single unit of that ownership, and a shareholder is the investor, someone just like you or me, who owns that share. To picture this, imagine a totally fictional company called ABC Tech. The founders of ABC Tech have decided to take their entire company and chop it up into 1,000 equal pieces. Each of those individual pieces is called one share. Let's do some super simple math to see how this plays out. If ABC Tech is divided into 1,000 total shares, and you decide to swoop in and buy 100 of those shares, you now own exactly 10% of that entire company. Seriously, you're a 10% owner. You have a legal claim to a fraction of the company's earnings and even a fraction of its decision-making power. You are officially a shareholder. So how does a company actually go about doing this? First off, you've got the business, just one large entity. Then, to raise money, maybe they want to build a massive new factory or hire a bunch of top-tier engineers, the company divides its ownership into many small, equal pieces. Each piece represents one share. Finally, an investor comes along with their cash and buys up some of those pieces. By trading their cash for those shares, that investor officially becomes a partial owner. The company gets the money it desperately needs to grow, and the investor gets a real stake in the company's future. It's a win-win. Now, this brings us to a really crucial question. Why do people buy stocks in the first place? I mean, why part with your hard-earned cash? Well, investors buy stocks because they want their money to grow. And there are two main ways you can potentially benefit from owning shares: capital appreciation and dividends. Let's break these down. And this brilliantly illustrates the first way you can potentially make money: capital appreciation. Now, that is just a fancy finance term that basically means the price went up. Let's say you buy a single share of ABC Tech for $10. You hold on to it for a year, and the company just crushes it. They do incredibly well. The market recognizes this success, and the price of that share shoots up to $15. If you decide to sell your share to another investor at that new price, your gain, before we even factor in any fees or taxes, would be $5 per share. You bought low, you sold high, and your capital appreciated. The second way investors can potentially benefit is through something called dividends. See, when a company is successful and bringing in profits, it has a choice. It can either reinvest all that cash right back into the business to grow even faster, or it can take a portion of those profits and distribute them directly back to the shareholders as a cash payment. That payment, that's a dividend. It's essentially a nice little reward just for being a part owner of a profitable business. But, and this is a really important but, not every stock pays dividends. Fast-growing tech companies usually plow everything right back into their growth, while older, more established companies are typically the ones paying out those consistent dividends. All right, so we know that if the price goes up, you can make money. But why do stock prices change at all? Well, it all boils down to the oldest rule in the book: supply and demand, interacting right there in the stock exchange. Think of the stock market just like a regular everyday marketplace. If a company announces a revolutionary new product, suddenly everyone and their mother wants to buy a piece of that company. More people wanting to buy creates upward pressure on the price. Buyers literally have to offer more money to convince current owners to part with their shares. On the flip side, if a company announces terrible news, current shareholders might totally panic and want to sell. If there are way more sellers than buyers, they have to lower their asking price to find anyone willing to take those shares off their hands, and that creates downward pressure on the price. Now, what's really interesting about this is understanding why that market demand shifts from day to day. Stock prices are largely driven by expectations of the future. Investors are always looking ahead. A massive driver of this is corporate earnings, basically how much profit a company is actually making. If a company reports earnings that completely blow Wall Street's expectations out of the water, the stock price usually jumps right up. But if earnings fall short, the price can drop incredibly fast. Beyond that, broader economic conditions like interest rates or even just general investor sentiment, whether people are feeling super optimistic or really fearful, play a massive role in pushing those prices up or down. To put this into perspective, think about the massive corporations you interact with literally every single day, the ones that make your phone, brew your morning coffee, or deliver your packages. These companies don't just have 1,000 shares like our made-up ABC Tech. When these massive companies list on major exchanges like the New York Stock Exchange or the NASDAQ, they often have millions or even billions of shares outstanding. And those shares are owned by millions of different investors all around the entire globe. Every single time you buy a share through your brokerage account, you are taking your place among that vast network of part owners. But of course, we need a bit of a reality check here. We've talked a lot about prices going up, but the market is very much a two-way street. If a company starts struggling or if the overall economy takes a nasty downturn, the demand for that stock is going to fall. If you bought that share for $10 and the market price plummets to $5, the value of your investment has decreased. And if you panic and sell it at that exact moment, you lock in a real loss. So the crucial point is that owning a stock does absolutely not guarantee a profit. Investing involves real, tangible risk. Unlike parking your cash in a traditional savings account, stock prices can and do fall. That means you can potentially lose some or even all of your invested money. On top of that, there is a very strict hierarchy if a company fails and goes bankrupt. The company's assets are sold off to pay back its debts to banks and bondholders first. As a shareholder, you're at the very back of the line. You only get paid if there is anything left over after all the big creditors get their money, which, unfortunately, usually means shareholders end up with absolutely nothing in a bankruptcy. All right, let's take a quick pause to test what we've learned. Imagine you buy one share of a company for $10. Fast forward a year, you check your account, and the stock is trading at $20. Based on everything we just covered, what are two possible reasons why that stock price might have increased? I want you to really think about it and drop your answers down in the comments below. Let's see who gets it right. Let's move to and see how this builds. Time for a rapid-fire recap. Number 1, a stock represents real legal ownership in a company. Number 2, a share is simply a single unit of that ownership. Number 3, investors potentially benefit in two big ways: through price increases, which we call capital appreciation, and sometimes through cash payouts called dividends. Number 4, stock prices are constantly rising and falling based on the real-time forces of supply and demand. And finally, number 5, investing in stocks always involves risk, and your investment can absolutely lose value. If this explainer helped you finally wrap your head around what a stock really is, hit that like button and make sure to subscribe for more simple visual market lessons just like this one. And hey, don't forget to answer today's question in the comments section. You now understand the basic mechanics of the market, but the real question is, are you ready to take on the risk to become a part owner of the global economy? Let me know your thoughts down below and tell me what stock market concept we should explain next. Keep learning, stay curious, and I'll catch you in the next explainer.